All right, welcome to Next Level Trading. We're just gonna talk about some of the features of using a time frame, using MetaTrader and TradingView, and how you can manipulate certain time frames to get what you want. Also, I'll just talk a little bit about the Gartley pattern. Go over that a little bit because I did have a lot of questions as to how that worked. So let's get that going real quick. Let's see, actually, that would be. Oh, and also I'll talk about how to combine all of these tools that we learned about. The head and shoulders, W's, M's, harmonic patterns, and how they all just formulate together to work out for one trade. Okay, so we'll talk about that as well. All right, so I just kind of want to zoom in on how to use the Gartley pattern, how to draw that up. Let me bring out this chart. They don't want to see us make it, they just want to divide. Okay. 2017, Bonnie and Clyde. Wouldn't see the point of living on if one of us died. Yeah. Got that kind of. All right, so the first thing you want to do when looking at the Gartley pattern, you want to make sure that you can identify. You want to make sure that you can identify your first swing. So here we have a swing high, being that looking left to right, price is going in the upward trend. Okay. Okay. So we got our first swing high, right? And then we look for our retracement. So the price will come back down. And then once the price come back down, we'll first have to find out whether or not this retracement is valid. Because if this retracement is invalid, then this whole trade is invalid, right? So you'll bring out your fill tool, and the valid retracement will be around the 0.618 level. That'll be our golden perfect scenario play out, okay? All right, so we got that. And so now, what we have now so far, we have an ABCD pattern so far. So far, I'm expecting an ABCD pattern. And we talked about ABCD pattern last time, and you guys should know about how that works so far. And so right now, I'm thinking that this reversal here is my C point. So price goes up, you find your swing high, and then you get your retracement. And so after your retracement hits the 0.618 level, which validates that this is a right pattern, you then want to go ahead and expect it to go even farther, right? So price will go up, retrace, and then go even further. And we call it ABCD pattern because this A to B is the same length as C to D, right? So let me. So it's the same length as, so AB will be the same length as CD. That's why we call it ABCD pattern. All right, so now what if price reverse short? Because in order to be a valid ABCD pattern, your D point has to always pass up your B point to make it a valid ABCD pattern. If your pattern stops short, if your D point stops short, we're now looking at a Gartley pattern, right? And so if price reversed shorter than the B point, we're now looking at a Gartley pattern, right? And so once we do have that Gartley pattern, this whole lettering will change. This no longer is an A, this is now your X. This is now your A. This is your B. This is your C. And so this will be the whole, whole arrangement of how you want to leather out this pattern. If you had your previous B point stop short of your A point, right? So keep that in mind with the Gartley pattern. You're trading the Gartley pattern. The biggest thing, because it starts off the same way as the ABCD pattern, it's just that this third leg has to end before this point right here. This point, okay. Just keep that in mind. You have a Gartley pattern so far, and everything's going good, right? Your D point has finished, and you want to know, where's this pattern gonna lead me? Because the completion of this pattern is considered a bullish harmonic pattern. Because after this ABCD or this Gartley pattern is finished, the result will give you a bullish run. So you want to look into that, right? Okay, so simply grab the fib retracement, bring it from the A point all the way to your D point. Okay, and this is how I do it. You want to use this point 382 level as your break-even area, right? So let's say you enter here, right? And then you'll have a stop loss like right around here. So this is where you have your stop loss. So you enter here. Let me What's fun about commitment when we have all life to live? Yeah, we're just So you enter here at this price right here is where you enter, right? But you have your stop loss right here. So just in case price keeps going down and you start losing money, because at this D point we're expecting price to go up. But you know, let's say price goes the other way that we don't expect it to go. We have a stop loss that can protect us and automatically close out the trade. So once we lose, let's say $2, then we automatically, you know, get out of the trade. We take the $2 loss and live to trade another day, right? So that's what our stop loss is all about. Now, once you bring out your fib retracement tool, you want to look at this 0.382 level, because once price hits all the way up here, you know, that's when you want to bring your stop loss to your entry point. So once you bring your stop loss to your entry point, you no longer, this is a risk-free trade, so you really have nothing to lose. Because if price were to reverse back to your entry, I mean, you would pretty much close out at zero. So 0.382 would be where you want to bring your stop loss to entry, and then 0.618 level would be where you would want to bring your that's where you want to close the trade and just take your profit. Okay, so you know, bear in mind, and you know, just use that to your advantage when you guys are trading. And pretty much what take profit means is that, okay, you're gonna take what you already, you know, you're gonna take what the market is giving you and just go from there. Okay, so you know, just keep that in mind when you guys are trading this pattern. And now there's also the opposite of this pattern, where you know everything is just the exact opposite. Okay, now let's see. You can also use the fib extension levels to mark out where you can take your profit. And you know, all you have to do is just you know, you start at the D point with your fib extension tool, and then go back to the A point and then back to the D point, and that should draw out your zone where you want to take profit, right? So you can use the fib retracement tool or the fib extension tool to give you your take profit on these harmonic patterns. Okay. All right. So let me do that real quick. Let me delete the fib retracement tool. So you go from D. And there you go. That's using the fib extension tool, and it's the same thing. So this level, this 0.382 level here, will be where you bring your stop loss to entry, and then your take profit will be around here. This 0.618 level will be your take profit. So it's the same thing, and I just want to go over that real quick because I know I had a lot of questions about that, and you know, just wanted to very much clarify how that worked. Okay. All right, guys. Okay. All right, so we're gonna talk about an indicator that, you know, is very useful and a lot of traders use. It's called the moving average, and it pretty much gives you overall average of price movement based on a given time period. Now, this moving average tool, there are two types of tools. You have the simple moving average, which is also called the SMA, and you know, it just gives you the average price over a given number of time periods. And then exponential moving average, which is also known as EMA, it gives you more weight to recent prices. Okay, and so the EMA gives you more of a general overview of where price is going in the short term, while the simple moving average is more over the long term. Okay, so it takes multiple number of time periods to give you, you know, the average of how price is moving. Okay, and so as you can see here, these lines are pretty much giving you like where price is going and how, you know, how the overall trend is going. Okay, so you know, let's say the green line is the SMA and the red line will be like the EMA. And how traders use this tool is simply they wait on the cross of these two lines to kind of indicate where the market is going to go. Okay, now this tool should only be used as confirmation and not as one and only reason for entry. Okay, so you should only use this tool in conjunction with other confluence of entry that you may have. Now, how to trade the average moving averages in the market. One of the most common way traders trade moving averages in the market is by combining the SMA and EMA indicators, typically setting the SMA period to 10 and the EMA period to 14 and waiting for a cross, which usually signals a trend reversal. Usually best served when the cross forms at the peak of a trend, right? All right, so like you guys see here, price was all the way up here. It was all the way up here. Then we got the cross, and look, price dropped. And then it went back up, slowly went back up, and it hit this peak here. We got another cross, and price reversed. So price is here, it's going up, it's going up, it's going up, it went back up. Then we get this cross right here, and we got another reverse, right? So, you know, it's the same thing over and over. And that's how a lot of people use these tools. It's not always 100%, but it's always good to use in conjunction with other areas of confidence that you may be using, okay? So just keep that in mind. All right, so here is pretty much just combining everything together just to give you a trade, okay? So we're trading high probability candlesticks, chart patterns, and harmonics all combined. And this is how you kind of want to use these tools, okay? You just don't want to use one. You want to use all of them combined to help you find a better entry to trade, right? And it's the same thing as I mentioned to most of you guys. Let's say you go to court and, like, you know, you're looking for, you know, the more evidence you have, the better, right? You know what I'm saying? If the prosecutor only has a limited amount of evidence, well, you know, it doesn't really make them more valid. Versus if they had a lot of evidence, you know, that actually can play more towards their advantage. But then again, just because all of these things, like think about the O.J. Simpson example, everything was going against him, right? The prosecutor had all the tools and all the evidence necessary to find him guilty, but he still was found innocent, right? So, you know, nothing's really ever 100% in the market, but the more evidence you have, the better. And this is just the point I'm trying to get across. So here in this first picture, sorry about that. So here in this first picture, the top right, we have a head and shoulder in conjunction with the harmonic pattern, right? And then we use the trend line as well. So that's very good to use as well. Here you're using the harmonic pattern as well. And look at this price action. You have a evening star that formed at the end of this harmonic pattern, which, you know, is even better confirmation. Here you have a harmonic pattern, but notice this trend line cutting through it. Price broke through that trend line and then retraced back to the trend line to go up. And you remember that was called a retest. So we got a retest with the harmonic pattern using the trend line here. And then so here you have a W pattern at the very bottom right. And so this is a W pattern that, you know, had confluence based on price action. So here we have a morning star, then we have another morning star, and then we have an engulfing pattern right here that you could have used as well. So, you know, just keep that in mind, guys, when you guys are trading these markets, that the more the better, okay? And so here's some more examples. So you have, you know, same thing. So you have the shoulder, head, and shoulders, just a closer view, right? You know, just better view of that. You know, these are, you know, even more closer view at the examples that we looked at. And so, as I mentioned before, you see how you had this trend line with the harmonics? Well, price broke through this trend line and then came back, you know, down to kind of test an area of past support. So this is how you want to use it. And then so here you have a W pattern, and it's not going to look completely like a W, but you know, you're going to be able to see it. And so here you kind of have a engulfing here, you know, price action here. Then you also have, this actually might be a triple bottom actually, because we have 3 taps to this price area, and they all include price action, right? So here we have what, engulfing, then we have the morning star, and then we have another engulfing, right? So that just tells you that, you know, the more the better, okay? And price went up off the triple bottom. And so here, as I mentioned earlier, you have the harmonic pattern, the Gartley. But notice this price action at the D point. We know that whenever we have a bearish harmonic pattern, bearish Gartley, that means after the D point is formed, we're gonna get a sell opportunity, right? Well, look at this. This evening star usually tells us, this price action of an evening star usually tells us that, hey, a sell is coming on top of the completion of the Gartley pattern. So that's even better. And as I mentioned, this is how you can use, all the tools that I've taught you guys in conjunction to kind of help you guys out. Seems like we have a question. Oh, no worries, Daphne. You're all good. You're all good. I was actually going over the Gartley pattern, and just kind of refreshing over things, But no worries, you're all good. Okay. No worries. All right, so I'm gonna get going. Okay, so trading time frames in the market. Okay, so we all know that. Yeah, no worries, Daphne. We all know that there's different time frames in the market, right? You have the weekly time frame, the monthly time frame, you have the daily, the 4-hour time frame, you have the hourly time frame, you have the 30-minute, the 15-minute time frame, 5-minute time frame, and you even have the 1-minute time frame. Okay, so those are the most popular time frames that traders use to trade. But I mean, I know in TradingView they actually allow you to adjust these time frames, and you can be able to use other time frames as well to kind of help you out. So instead of hourly, you can use like a 45-minute time frame where candles are born every 45 minutes. And so, looking at the daily, a candle is born every day. Or if you're looking at the minute, the minute chart, a candle is born every minute. Okay, so that's pretty much how those candlestick patterns work in terms of time frame. Gives you the overall average of price movement based on the given time period, right? Now, when looking at time frame, the higher the time frame, the more likely that the pattern is to play out and the less noise you will see. Okay, so if you go on the minute chart, you'll notice that price is moving crazy. You know what I'm saying? Like, it's going to be very active, right? Versus if you were to trade on versus if you were to trade on like the daily, well, candles form every day, so it's going to be moving a lot more slower. But the liquidity in the minute chart is going to be a lot more intense. So you want to keep in touch. You want to keep that in mind as well when you guys are trading. Okay. Actually, also want to make sure that you bear in mind that the higher time frame always gives you a big picture. It gives you a bigger picture of what's going on. You know what I'm saying? Like, and you always want to use the bigger time frame, especially if you're trading and holding trades for days. So if you're trading and holding a trade for a couple of days, well, trading on a minute chart wouldn't be beneficial to you, right? So let me show you guys an example. Make yourself some friends or you'll be lonely once I was 7 years old. So here you guys can see on the right, I have this timer here, and this is on the daily. What it's saying is that we have 21 more hours until a new candle is born, being that a candle is born every single day, right? Right. Okay, so now notice how like there's rarely any movement here because prices is forming within a bigger time frame. Versus, let's go to the minute chart, right? 1 minute chart. You'll see a lot more action within the 1 minute chart. It should be going crazy right now. It's not really moving. Let's go to a US pair in the US session. Okay, so you kind of got a little bit of movement there, but so the thing is, we're really not in a volatile session right now. But if you guys were in the volatile session, you guys would be better able to see how fast price moves, and you can see that jump right there. It's kind of moving a little bit too, but if you guys witness it during like this actual like a session where it's more volatile, I mean, price is jumping up and down, jumping up and down. And it's kind of doing that here. As you can see, it's kind of consolidating and waiting for the next session to happen though. So, but notice here, I mean, you can barely see anything. And this is the daily time frame. I just switched to the daily time frame, and you barely see anything. If you go back to the minute, you see how 36 more seconds left until a new candle is born. It's a lot more frequent, you know. But you know, trading, the lower the time frame, you know, the more wild that time frame is, you know. So that's definitely one thing you want to bear in mind. That's definitely something you want to bear in mind when you guys are looking at this chart, at these charts. No, you're good, Grant. Okay, I got you, brother. I got you. Let me turn on the music a little bit, guys. Okay, cool. Awesome. I hope that's a lot better for you guys. Let me pull up the PowerPoint. No worries, brother. So what we pretty much covered so far, guys, we went over how to create a Gartley pattern again. Okay. We went over how to create a Gartley pattern. Then we also went over how to use, you know, the Gartley pattern, price action, trend lines, and you know, like W formation, and also moving averages, all in conjunction to give you a better accurate trade. And you guys will see it on the recording for those who are late, but we just got to get moving right now due to time's sake. Yes, sir. Yes, sir. Just like last class, I talked about that, and you know, but you guys will definitely, if you guys have any questions, just hit me up, and I'll be more than willing to help you out any way that I can. All right. So as I mentioned earlier, the higher the time frame, you know, the more accurate and more higher probability that, you know, your trade is going to play out. Typically, want to use the higher time frame to give you an idea of where the market is going, and then you use the lower time frame to give you an idea of when that particular pair is going there, right? So when you're looking at a higher time frame, you're thinking about the what. Now the lower time frame gives you the when. Okay, so the lower time frame entry will give you a more precise entry point and limits down draw. Okay, so if you were to see a W formation on a daily time frame and then went down to the hourly chart and saw an inverse head, and if you went to the hour, okay, so let me start over. Okay, let's say you were looking at the daily time frame and you see a W formation, right? And you know you're right at the neckline of that W, and you know how we enter off W's as I mentioned in the earlier class. But it's a whole daily chart, so you have to wait almost a whole day for price to really get to where you need to go to, right? But another thing is, let's say that you've seen an inverse head and shoulder, which also gives you a bullish push, a bullish market, and you've seen that on, you know, the hourly chart. Well, you can enter off that because that's the earlier entry for you. Being that a candle forms every hour, you enter on the hourly chart. That's the early entry for you, and you know you can just ride that in conjunction with the daily chart where the W formation is forming too. So at the completion, the inverse head and shoulder pattern on the hourly time frame will be when you can enter. And so instead of waiting for the daily candle to complete, you can just enter off the 1 hour chart because it's also giving you a bullish push, and you can, you know, have a more precise entry. Okay. You'll be looking for nothing but bullish confluence and bullish entry. So yeah, so like if you like see a W forming on the daily chart, well, you just go into the lower time frames, you know, the quarter hourly, the hourly, the 30-minute, and see and try to look for any type of bullish entries on these lower time frames. So you want to look for a W because that gives you a bullish push in the market after completion. Inverse head and shoulders give you a bullish push after completion in the market. Sausage bottom, so forth and so on. And so that's how you want to trade these markets, okay? Because we know that the higher time frame gives you exactly where the market can go. Now when you go in the lower time frame, that just tells you, like, when that market is going to go there. Okay, so just keep that in mind, guys, when you guys are trading these markets. So that way you guys have a better precise entry and aren't taking that much down draw, when you guys are trading. Okay. Now this next bulletin here, if the higher time frame doesn't match up with the lower time frames, then the likelihood of profiting from an entry on the lower time frame is lower. But that doesn't necessarily mean that it won't play out. Okay, so when you trade these markets, hold on, I think we have a question. Right, yeah, and it's more conventional. Daphne just mentioned that she never have traded a 30-minute time frame before, and once you go on Trading View, there's actually an option to allow you to set and adjust these time frames. So I mean, it's more conventional for traders to trade the hourly, 5-minute, 15-minute, the quarterly chart, the daily hour chart, and the weekly and the monthly. But you can adjust it in Trading View to have quarterly results. You can actually make it that way. So there's different ways people look at the time frames, but it's more conventional with the hourly, quarter hourly, daily, weekly, monthly. We're all conventional, comfortable with those types of time frames. But just keep that in mind when you guys are trading, that you can adjust it. But so far I hadn't had any problem with these conventional time frames, so I'll just stick to them for now. But if need be, no worries. You can go ahead and change them accordingly. Okay. Now, so the best scenario is, like, let's say that you see the daily, right? And on the daily, you have a W formation, right? And let's say on the quarter hourly, you have a W formation. And the quarter hourly just means that every 4 hours a candle is born, okay? And so let's say on the hourly as well, you see a W formation. And on the 30-minute chart, you see a W formation. That's the most perfect scenario ever, because on every time frame you are having bullish confluence, and I mean that the probability of that trade playing out is super, 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 super high. Now, granted, it doesn't necessarily all have to be W patterns, but let's say on each time chart or each time frame, let's say on the daily you had a W, which is a bullish, entry, and on the quarter hourly you had a inverse head and shoulder, which is a bullish entry, and then on the hourly you had, like, let's say you had a saucer's bottom, which is a bullish entry as well. So you have three different patterns on three different time frames that are showing you bullish push, which is even better. That giving you more confirmation, and that's pretty much, I don't want to say it's a perfect entry because nothing is 100%, but that gives you a high probability of that trade playing out. Now, granted, just because like the higher time frame doesn't match up with the lower time frame doesn't mean that you're completely gonna lose that trade, but that probability isn't as high anymore. Okay. Now instead of using high risk on that trade, you want to make sure you put your trade at a very low risk. You know what I'm saying? You're not gonna be as confident in that trade, so you're not gonna risk as much, right? Not all exact time frames have to be in alignment. As long as you have two or more, you should be fine, right? So you don't necessarily have to have the monthly, weekly, daily, quarterly, hourly, um, 15-minute, 5-minute, and 1-minute chart all just be showing the same thing. As long as I think it's really good. I mean, if you have two time frames that are showing you bullish push, then that's pretty much good enough, if you ask me. Now, granted, you just don't want to be using the time frames and the pattern. You also want to use some other confirmations as well, but just keep that in mind when you guys are trading. Now, one thing I want to mention is that it's preferable if you were to trade the time frames based on your own personal time and daily life, right? And so, for example, if you're always busy, but it will behoove If you're always busy, it will behoove you to trade the higher time frame, the daily, weekly, etc. Right? Okay, so I say this because a lot of people may be working full-time jobs and they're off on the weekends. Okay, and the weekends are perfect opportunities to trade, especially if you're busy during the weekdays, because the market's closed and you're able to just go through all the pairs and see what pairs are showing you what and take advantage of them once the market opens again. And so if you're trading the daily time frame where every day a candle is formed, well, that's gonna play out in your favor, right? Because um you're not gonna be at the computer all day or every other couple of minutes, and so you want to use the daily time frame to do your trade. Versus if you were a full-time trader, right? You want to be using, what I'm saying, you want to be using perhaps you can do the 15-minute chart, or you can use the hourly chart because every hour a candle is born, right? And the market moves a lot more faster, but that's okay because you're in front of the computer and you're there to manage the computer and make accurate trades. So I highly recommend that you trade accordingly, like to your schedule. A lot of people are busy, and so that can play to your advantage when you don't have that much time and just using the higher time frame like the daily or the weekly. Nothing's wrong with that. Now we also have the intraday time frames, pretty much time frames within a day. So you have the 10-minute, 30-minute, hourly, quarter hourly, etc. And that's just a definition or deal. Just going from there. All right, guys. So here's an example. Okay. This is beautiful, and I caught this out a couple of weeks ago. So here you see this white line. This marks a specific point in this marks a specific point. This is a specific date and time. Okay, so let's say that this is March the 3rd at 10 p.m. This white line right here. Let's say it's March the 3rd at 10 p.m. We're on the quarter hourly chart, right? I go on this 4-hour chart and I see that, okay, we got a head and shoulders. Okay, that's nice. That's pretty nice. Then I go on the 1-hour time frame and I see we got a head and shoulders as well. Then I go on the 30-minute time frame and I see that a head and shoulders completion has formed, right? And we all know that these head and shoulder patterns give us a bearish market, meaning that we're looking to sell. So at this point in time, I'm like, okay, let's do this. And bam, market drops. I want to say that was like a 200 pip drop. That was a big drop. So yeah, just keep that in mind. Like using these time frames in conjunction when you're trading, it's just, I mean, they are really good. They can really help you a lot too. So just keep that in mind, guys, when you guys are trading. All right, so we talked about this during the group, but also want to talk to you guys in person as well during the webinar about. I want to talk to you guys about trading market sessions. So you may ask me, okay, what are market sessions? Market sessions are times during the day in which certain markets, U.S. market, Asian market, London market, etc., within the world are the most active, or when certain currency activities are the most liquid. Okay, so for example, 7 a.m. in the U.S. is usually when we get up and begin our daily routines. Shopping, or putting in gas, going to the gas station, buying stuff. Uh, checking out the hotels, paying whatever it may be. And so with that being said in mind, the U.S. session begins and the U.S. dollar moves more frequently because you have a lot more transactions being done with the U.S. dollar, right? And that translates on the chart as more liquidity, right? So the market moves a lot more faster. So any pair with the U.S. dollar will be able to increase in liquidity. That's why it's beneficial for you to trade pairs within their own sessions. So, for example, Euro versus USD, you want to trade that out in the London or the U.S. session. I actually mentioned that here. As I just mentioned, it's more preferable for you to trade certain pairs within the market session. Example, trading the Euro USD pair in either the U.S. session or London session is fine. But trading the the Euro versus USD pair in the Asian session will not really produce much profit, right? Because the market isn't moving the market really wouldn't be moving as frequently as it would be if you were trading that pair within that market session. Okay. Okay. Session hours. So these are all the hours in which these markets open, and do keep in mind this is Central Standard Time, so just adjust it accordingly to where you guys may be at. So yeah, so you have the Asian session, which starts at 6 p.m. my time and doesn't end until midnight. You have the London session, which starts at 2 a.m. and at 11 a.m. You have U.S. session that starts at 7 a.m. and doesn't end until 4 p.m. Then you have the Sydney session that starts at 4 p.m. and ends at midnight, right? And then you also have overlapping sessions, okay? So overlapping sessions when you have two market sessions within one time period. So from 7 p.m. to 7 a.m., you have both the Asian and Sydney session active. From 7 a.m. to 11 a.m., you have the U.S. and London session active. And as I mentioned before, was an overlapping session. It is when you have two sessions that are still active, making that time period even more volatile. So now you have two sessions within a time period, and you're able to make a lot more money than if you would just have, one session within one time period. Okay, so just keep that in mind, guys, when you guys are trading. Oops, 1 second, guys. So yeah, just keep that in mind, okay? All right. All right, so trading sessions in the market, GMT, which stands for Greenwich or Mean Time. Yeah, Greenwich Mean Time is just an abbreviation of what that is. And so when you guys are looking at your platforms, whether it's MetaTrader 4 or TradingView, there's a worldly time marker that you can look at. It's just a worldly time marker, so anywhere within the world, you guys will be able to tell, where a price is at, or if you wanted to do some back testing, meaning going back in the market in the past and seeing, what happened with price at a particular time, you can do that. Okay. It's just known as the World Standard Time, and you will find this time on your trading charts and platforms I mentioned earlier, MetaTrader and TradingView. But bear in mind that these times on the right are all in Mountain Standard Time, so adjust accordingly to your time zone, right? GMT plus a certain number just simply tells you how much ahead you are in the GMT. So in the example to the right, it would be GMT plus 3, because price is pretty much ahead of the GMT time zone 3 hours. So just keep that in mind when you guys are trading, and just think about that. All right, guys, we're going to take a quick break and come back to this real quick. I will resume the session. You need to go grab some water, but I'll be right back, and we can go from there. So I'll see you guys in a couple of minutes. All right. And also, it'll be the same meeting ID, so you guys will be good. I'll see you guys in a couple of minutes. All right.